Do I think backtesting is overrated? I think that backtesting gets focused on way too much by traders who get obsessed with going back, trying to analyze everything, but that doesn't mean that you're going to be able to read the market in real time. So for me, I think that backtesting is a good starting point for making sure that you have a way of looking at the market that has worked over time. But really, once you don't want to spend too much time doing it. You want to get your strategy figured out, and then you want to start forward testing with live data. So you want to start testing on the simulator in real time with real live market data so that you can see if your strategy proves to work in real time and if you can follow it in real time. And only then will you really know if you have something special and if you have a real edge. You're asking why traders will change their strategy after just like one bad week. And I think if you read this book right here, this is called The Mental Game of Trading by Jared Tendler. And it's a system for solving problems with greed, fear, anger, confidence, and discipline. I break down this book in depth in my course. And the reality is that this is a really good book for explaining why this happens. And basically, it comes down to tilt most of the time. So it's in here. There's a whole thing about mapping your fear, mapping out greed, finding the root of your problem, mapping out your problem, confidence, discipline. So there's really a lot of factors that go into why this happens. But basically what happens a lot to traders is that they'll start trading, they'll think they have a good strategy, but they will not have tested it long enough to have a real serious confidence in it. So what'll end up happening is maybe they test it for like a couple days, or they start trading it too early before they've really tried it on the simulator for a while to have confidence. And then when they take a loss, they go, oh, this strategy must suck. And what that is that it's ego. They're not getting to the point where they're actually going, you know what, the reason that I'm having losses is because I'm not being disciplined. Because most of the time, they're having the loss either because they don't understand the strategy fully and they're trading too soon with it, or they are just psychologically not prepared and they're breaking their own rules and they're doing things that they shouldn't be doing. And that's the reason the strategy isn't working, not the strategy itself. Now, of course, you can have just a bad strategy. You have to have a good strategy first that has an edge. But you'll know that if you've tested it on the simulator and with real data for a long enough time to know if it actually can work. So the big thing is a lot of traders get what I like to call the same thing that entrepreneurs get, which is shiny object syndrome. They get distracted by other tactics and techniques. They have a few losses and they go, oh, this strategy must be terrible and I got to switch to something else. I did that. When I was first learning price action, I actually abandoned what I do now more than once because I didn't stay disciplined on it. And that was earlier on in my career before I knew what was happening, before I knew that that's what I was doing and that I had a propensity to abandon strategies that worked and not take full ownership. Because the thing is, most traders are not taking full ownership of what they're doing. You have to take full ownership and accountability when you're trading, and know that if you lose, it's your fault. Like if you take bad trades, it's your fault. It's nobody else's fault. It's not the strategy's fault. It's your fault. Once you have a strategy that has an edge to it. So it just comes down to a lot of discipline and work over time. So that's what I would say about that. Is trading more mental or technical for me? I would say that trading is really, it's not more one or the other. The way that I look at trading is it is technical and it's mental, but it's also intuitive. I actually think that there's three components to it. So first, you have to have your technicals in play. You have to have a strategy that has an actual edge. So you have to have a way of looking at the market. For me, that is price action trading. I have my strategy and it's very technical. It's based on what's happening on the chart. There's no emotion involved with that. It's just the actual technicals. So that's the first part. The second part is the mental game. So my psychology, making sure that I'm following my rules, that I'm not hesitating, that I'm confident in my strategy, that I am not breaking the rules, that I'm not revenge trading if I take a loss, like that sort of stuff. There's a mental piece to staying consistent. And I talk to people all the time who understand the strategies, but they'll still tell me things like, oh, when I take a loss, I end up tilting, and then I just start taking trades that are not good, or I only take green arrow trades after I have a loss, and I don't wait for the proper good, like really, really good setups. and that sort of thing. And not that you can't take the green arrow trades, but you need to, if you just start forcing every little setup after a loss, that's a bad move. So the second piece is the mental game. But the third piece is what I would call like the intuitive game. And the intuitive game is really like what comes from practice. So you'll start to have a feel for how the market is moving with more screen time. Part of the beauty of using tick charts is that I get to see how fast or slow candles are printing, and that tells me a little bit about how the price action's moving. And it helps me have confidence in the moves themselves. Like when I saw this one over here with this huge bar, a lot of people would be scared of this. But to me, this is actually telling me, hey, look, this bar was huge because a bunch of longs got trapped here, and it went one tick in their favor and dumped on them. And everyone's stop losses for the longs were below that level and then below this level, and they're going to get stopped. So I actually had a lot more confidence to enter short on a candle like this, whereas some people would be more scared of that. So that comes from like an intuitive feel of the market that you get from just time in front of the chart, time watching this print every day on the same asset. The reason I'm such a firm believer of trading one thing, so for me that's the ES on a 2000 tick chart, is that you're going to get a feel for the market and how this thing moves and become an expert in it. Whereas if I start looking at a bunch of different instruments, it's going to be hard for me to get a feel for how each one of them really moves, because I can't really analyze that and watch it bar by bar. And the whole thing here is I'm watching this thing bar by bar, so I have an intuitive sense for if I'm taking a good trade or not. Like I know what congestion looks like on the ES. I have an intuition about the market that comes from just practice. You know, it's like a discernment and an intuition. And that comes from just, you can't replace that except by having hours and hours in front of the chart trading it. So that's the third component. So I'd say it's, you know, it's the technicals, the strategy, the edge, then it's the mental game and the psychology, and then it's like that intuition, discernment, and just experience. It's those three components. What mistake cost me the most money? Ooh, that is a tough question. I think that my answer would actually change based on different parts of my trading career. So if I wanted to talk about what mistake cost me the most money in trading, I would say that over time, there's been different points of my trading where different types of mistakes have cost me different amounts of money. Early on, I would say that the biggest mistake I would make was that I used to ladder my positions where I would take more than one entry. So I would try to average down my position. So I would instead of entering all at once, I would enter and then I would enter again at a lower price to try to get a better position. And then I would try to basically DCA my entry, which means dollar cost average my entry. And I think that cost me more money than anything else, because what would happen is you start dollar cost averaging your position and you still end up taking a loss because it keeps going down. So to me, instead, now what I do is I go all in on my position in one place. My stop loss goes in one specific place, and then I exit in twos. So I exit most of my position for a scalp, and then I leave the other part as a runner. And that way, you know, if I'm wrong, I just get stopped out. I don't try to average things down and stay in a bad trade. So that one cost me a lot earlier in my career. I haven't done that for a long time, but that's the way I used to do it. And dollar cost averaging can work well for an investment strategy, if long-term investing, but that's not what we're doing as scalp traders. So for scalping, I just don't think that it works very well. And then, yeah, Monte Carlo is another thing that they call it. But yeah, I don't like to use that in my day trading. I think that that's better for investing type stuff. If you're investing and averaging in your price and that sort of thing. So that would be one of the biggest mistakes that cost me a lot of money. I would say the other biggest mistake, the more recent, I'd say biggest mistake that has cost me a lot of money in trading is not drawing short-term trend lines enough. It's very, very important to draw short-term trend lines. For example, doing stuff like this. Now, this is an equal high, so I would probably start one from here. It's very important to draw your short-term trend lines whenever you have 3 candles. So I don't draw it until I have 3, but when I start to have 3 candles, I'll draw a short-term trend line. And I used to not always draw them, and that made me cost me a lot of money, because there's times where I entered trades that I wouldn't have entered had I drawn a short-term trend line and realized that the short-term trend line was still in play. So I'd say that is the other mistake that cost me the most money, at least as a price action trader. All right, so you asked what finally clicked for me in trading. I think what clicked for me was having a higher win rate and not having a super huge target. So it kind of goes with that last question. For me, I found that having a high win rate made me more psychologically intact and not having to sit through a bunch of drawdown in a trade. That was a big deal for me. So when I started to focus on high win rate, quicker trades where I'm just in and out with my scalp, low stress in that way, everything clicked for me as that being a superior way for me to trade and to stay intact psychologically, be less likely to mess around.